Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am your host, Christopher Cahill. Later on in this program, we will have an interview with Ron Miller of StartEngine.com. StartEngine is, of course, two words in one word, and they're spelled normally. Mr. Miller will discuss why unaccredited investor crowdfunding, or what we on this program like to call true crowdfunding, because it's, after all, the crowd of unaccredited investors, that is, everyone. So he's going to discuss why unaccredited investor crowdfunding will be a boon for accredited investors, that more limited group of investors who have sufficient capital not to be as closely protected as the public at large. But first, a few remarks from relevant recent writings. When I say relevant recent writings, not all recent writings are relevant. It's a commonplace to note some of the failures of journalism, and that includes financial journalism. I'd like to point out one particularly laughable failure from CNN.com. We all make mistakes, of course, but on June 2nd, 2014, CNN.com published an article by Melanie Hicken entitled "Millennials Are Saving for Retirement at a Much Early Age." In it, the article stated, millennials are not only saving for retirement at an earlier age than their parents' generation, they are also saving more aggressively. That was June 2nd, 2014. 4 months and 8 days later, on November 10th, 2014, CNN.com published an article entitled "Millennials Aren't Saving a Dime." The article is written by Aaron Smith. The article stated that cash-strapped millennials are slipping into the red. People younger than 35 are not saving money, according to a study by Moody's Analytics. In fact, their savings rate has dipped to negative 2%, meaning that they're spending more than they have. They're the only age group that has a negative savings rate. In contrast, workers between the ages of 35 and 44 have a positive savings rate of about 3%. Now, I wish the editor had caught this, because there was a potential for referring to the earlier article and making it a real conversation about what statistics were being used. But the editor didn't catch it, and now I wonder whether Adam Smith and Melanie Hicks are still friends. Speaking further of journalism and its enthusiasms that sometimes cause it to lose its way, there was a recent article in Bloomberg entitled "Madoff's Scorecard in Billions, 17.5 lost, 10 recovered, 1 to do it," written by Eric Larson, dated November 21, 2014. Now, if you remember in 2008, when Madoff was originally caught and the prosecution began and his bankruptcy began, the breathless totals flung around over how much he lost were much larger than $17.5 billion. The prosecutors in his criminal case stated a loss of $64.8 billion. The numbers got even huger in the civilian press, because after all, large numbers sell newspapers and get hits on the web. The 17.5 is the amount lost in principal. That is, you give Madoff $1 million and he loses some of it. It does not include so-called losses that would be your expectation. Madoff said you would get X percent every year, and you believed him because you weren't paying attention, or you wanted to believe him. That amount you're not entitled to. So if that's a loss, that might account for the larger figure, but it's not really a loss. At any rate, $17.5 billion was lost from the principal of his customers. $10 billion has been recovered, and the trustee does expect to get the rest. Well, all right. We're so wise now. We are Monday morning quarterbacks. Frank Sinatra sang, "The Monday morning quarterback never lost a game." Of course, he was not singing of football, nor was he singing of investment fraud. He wasn't even singing about investments. He was singing about what he always sang about, which was love and loss. Well, let's do a little Monday morning quarterbacking on investments. Barron's in May of 2014 published an article by Andrew Berry entitled Why Barnes & Noble Could Double. Now, as far as headlines regarding predictions of could doesn't give you very much faith, but it was a combination of analysis and prediction. So let's see, Barnes & Noble was around $16 a share in May. Did it double? Well, the article discussed three scenarios which could cause this doubling. One, the company could split into three companies, retail sales, college bookstores, and the Nook business. The Nook business was a kind of partnership, not in the legal sense, but rather in the sense of involving joint investment with Microsoft and Pearson PLC. So it could split. That would cause a greater value to the ultimate shares of Barnes & Noble. Or there would be large stock buybacks, or there would be a sizable dividend, or some combination of these three. Well, there was no dividend, and there was no large buyback of shares in general by Barnes & Noble. However, Barnes & Noble did buy back Pearson's stake in Nook, and Barnes & Noble did buy back Microsoft's stake in Nook. So now Barnes & Noble controls Nook. And now, according to the Wall Street Journal and other commentators on such things, Barnes & Noble's way is clear to split into two companies, and it looks like it will in the middle of 2015. There will be a Nook company and the rest of the company. Well, all right, so how did Mr. Berry's predictions bear out to this point? Well, it looks like Barnes & Noble will split. The stuff about buybacks and dividends ended up not being the case. And we've gone from a $16 a share in May of 2014 to early January price of $23.50 a share. So if he predicted that the shares would double in value, he is halfway home. Well, that's enough from me. Let's get to the interview.
This is Alicia Purdy, Managing Editor of AccreditedInvestorMarkets.com and your host for this week's broadcast. Ronald D. Miller is an entrepreneur's entrepreneur, having visualized, founded, built, and sold 5 companies. Ron is a 4-time Inc. 500 5000 award recipient and an Ernst & Young Entrepreneur of the Year award finalist. Ron is a partner in StartEngine, LA's largest tech accelerator. He's especially passionate about cause-based entrepreneurship and holds the trademark for, quote, doing well by doing good, end quote. Ron, thanks for joining us today. We're talking about why unaccredited investor crowdfunding will be a boon for accredited investors, and we're really glad to have you.
Well, thank you. Appreciate that, Alicia. It's my pleasure to be here today.
So, as I just mentioned, why unaccredited investor crowdfunding will be a boon, meaning a good thing, for accredited investors. And right there, that opening statement is eye-catching because it could be somewhat controversial, and there are some pretty clear opinions on both sides of the debate. Can you discuss for a little bit for our audience, which is mainly accredited investors, why unaccredited investors could be a boon rather than a threat to crowdfunding as we know it?
Certainly. Well, I can understand what you mean by there is a conflict, and certainly lots of discussion on both sides of that topic. However, what I believe is that unaccredited investors are going to serve largely to help vet teams, vet concepts, and ultimately develop markets and marketplaces and a market following from which then are self-selecting to some degree before the accredited investor will see those opportunities. So in other words, it's a methodology by allowing unaccredited investors to crowdfund under Title III and invest in those companies. It will serve as a filter, let's say, to then serve up to the accredited investors just those opportunities that have been proven and vetted in terms of the quality of the team, the quality of the concept, and of course bringing to bear an entire powerful social media network of the unaccredited investors who put the money into those deals in the first place.
Okay, so let's take a step back for 1 second for our audience. Again, I mentioned that we are comprised mainly of accredited investors, but whether you are or not one, what is someone who is not an accredited investor, besides just, wealth or a few $1 million? What are some of the nuanced differences between the two groups?
Okay, so the differences between the two, at least in terms of what an accredited investor currently is defined as, is someone who's got a net worth exceeding $1 million, excluding their residence, or has an income of $200,000 as an individual, $300,000 if they're a joint filer. And of course, if they're a trust or an entity, then they need a net asset value or net worth of more than $5 million. So that's what defines it today. Now, there's also differences, and I think significant differences demographically between an accredited investor and an unaccredited investor. It tends to be, and again, there's certainly exceptions, but it tends to be that accredited investors typically are over age 50. They tend to be more in the baby boomer demographic. And their purpose in investing tends to be more focused on, if I make an investment, what is my return, how much will I earn, and when will I be paid back? That's the typical accredited investor. In contrast to that, an unaccredited investor is someone who does not meet the qualifications that the SEC has set up for an accredited investor and tends to be younger demographically. Now, if we look more closely at the demographics of who have been the predominant investors in the gift and donation crowdfunding space, including the leading portals of Kickstarter and Indiegogo, those people tend to be, generally speaking, less than 35 and even more so under age 30. And so demographically, they're very, very different. And further, the under age 30 also tends to invest for a different purpose. They have a desire to be connected with and supportive of causes, people, and companies that are making the world a better place. And that is the primary driver, with a secondary driver being the financial return. So there's a very different purpose. And I would also mention that in addition to that, it's rare that you'll see an accredited investor who invests in technology. They just generally don't do that. They also tend not to invest often in startups. And finally, they are not likely, an accredited investor is not likely to use an internet portal as the means of accessing an investment opportunity. So while we are seeing some activity there, it's predominantly in the real estate related fields that we see the current activity of crowdfunding among accredited investors. In contrast, we're likely to see more technologies being brought into the market by the unaccredited investor crowdfunding portals.
That's actually an excellent segue into my next question, which is twofold. Is what can an unaccredited investor, who you just mentioned, they're younger, they're interested in almost a completely different set of projects. What can they do for how projects are funded? And I would actually add, can they do anything of value for the type of projects that an accredited investor would go after versus the ones that they usually do? What do they bring to the table for any type of given project?
Well, the unaccredited investors, skewing younger demographically, are going to be more knowledgeable about whether there's a real market opportunity or not for new technologies in particular, as well as media. And because of that, they're going to bring some knowledge and wisdom, some of it coming through the wisdom of the crowd, other through individuals who will bring their individual wisdom to help a startup both develop its products or services and also how they're marketed. So I think that's something that's relatively unique that an unaccredited investor can bring that the accredited may not be as well suited for.
Let's talk for a minute about the wisdom of the crowd. And that is a different aspect of crowdfunding versus what an individual accredited investor might bring to the table. Are there pros and cons, and what are they, of the wisdom of the crowd if an accredited investor might feel like, listen, I don't want to be involved in any kind of investment where 100,000 people have a say. What's the benefit of the wisdom of the crowd, and what are some of the drawbacks?
Well, it is true in the studies that have been done on it that there are the wisdom of the crowd tends to show up in the investment specter, like we're discussing today, by reducing the number of false negatives. In other words, it's been shown that experts, people who have deep knowledge and domain experience, often will turn down opportunities that in fact turn out later to be proven to have been successful. Whereas the crowd, it tends to be more likely to endorse a concept that ultimately will succeed. as opposed to the false negative by the experts. So that's one aspect of the wisdom of the crowd. Further, where investment or crowdfunding has been already in place in a few countries, it's been shown that the number of companies that are succeeding are also exceeding the averages of what are typically funded by the individuals. So what we're seeing is the crowd is actually pretty smart when it comes to selecting which opportunities are going to be proven to be economically and financially viable. And I believe that in that way, the unaccredited investor crowd is going to create opportunities and deal flow that have higher probability of success for both accredited investors, who might be angels, or also for the venture capital community as well.
Is there any kind of, and I'm just recalling freshman psychology class here, but is there any aspect of groupthink that would undermine the wisdom of the crowd? Is there any kind of herd mentality of like, we're going to go in this direction, and then we find out later it was a horrible direction, but everybody was doing it?
You know, it's always possible that that will happen, although I would say that that possibility has not been proven by the actuarial experience of the crowdfunding portals that have been operating in other countries for the last few years.
Okay, that makes sense. And I was sitting here thinking, you know, sometimes I worry about the wisdom of the crowd becoming, you know, the push of the herd. And so if it's not that big of a problem, it's good to know that, because then that does reduce the idea that they could be a threat to an investment, that it's not just a bunch of people, a school of fish, you know, moving in one direction.
But also on the other side of that, also there is the requirement in setting up the rules for Title III. The SEC has basically required that the portal keep open to the public, to the investing public, all of the comments, both positive and negative. And in my experience, equal to as much pressure as you get to go with the crowd, there are also many individuals who seek to have their voices heard and to be validated by being the critic. So I think that we're likely to see those voices be equally heard as well as those of the crowd.
Well, and right now, as we're talking in this exact date about crowdfunding and the unaccredited investor, we're really talking about something like a Kickstarter or an Indiegogo, as you mentioned earlier. Right now, where we are there other places where unaccredited investors can make a discernible and relevant, useful impact in the crowdfunding space, or is that really something they can only do after there's been rulemaking and everything's in place for them to move ahead with equity investment?
Well, that is basically correct. I was going to point that out, but I think you just pointed it out as well there, Alicia, that today an unaccredited investor can't really invest in equity ownership or participate in the financial outcome of companies that are raising capital through Kickstarter, Indiegogo. Those are really just sort of almost pre-purchase of the product itself, and in some cases there's rewards that go along with it. They sometimes refer to it as rewards-based crowdfunding. Powerful story there was through a small company called the Oculus Rift, who created a gaming headset that was a virtual reality headset, and what they did was they raised, I think it was $2 or $3 million on Kickstarter, and when I say that, what they did was they raised the capital of investors who really wanted the product, and they took orders for those products. They didn't yet ship them when ultimately the company was sold to Facebook for something like $2 billion, and the people who had helped Oculus get its start by becoming investors on that Kickstarter campaign got zero return. And the reason why was because they really aren't investors. They were just simply pre-purchasing the product. It's that exact paradigm that the SEC and Congress actually recognized, that through the Jobs Act, they are essentially creating what's called the democratization of finance in private companies by allowing unaccredited investors to participate in the same way accrediteds do.
Okay, and if you could talk for just a minute, we did touch on this, and I'm just switching gears a little bit here. What motivates accredited investors versus unaccredited investors in crowdfunding specifically? You mentioned how these younger unaccredited investors tend to go after things that are maybe startups and tech, and they invest according to their heart, I suppose, would be one way to put it, versus the older accredited investor who's really looking for the return. Those are some of the differences and similarities. Are there more than that? Does it get more complex, or is it that's really just the long and short?
Well, I think that's at a high level. That is the kind of the overview of it. And of course, we're yet to implement the unaccredited investor component of the Jobs Act, so we don't have empirical data on this. But I strongly believe that what we'll see is that in addition to the motivations we talked about earlier to do something great, it also is self-validating, where if I'm a unaccredited investor, and in particular I'm a millennial and I invest in a great company that I believe in, I then will push out that fact to my entire social network, which in many cases are hundreds of people that I'm going to push out a note saying, hey, I'm now a partner, I'm now an investor in this company or this product, and I really believe in it, and you guys should check it out. Now, what's becoming also known is that social media network of the millennial is very, very powerful, and to a large extent will displace the traditional media and advertising modalities that are used today by a lot of companies. And here, it not only serves as self-validating, but it also allows the companies to get some pretty deep and consistent and loyal ambassadors that will continue to promote that brand to their social network, which is a primary way that millennials validate and make purchase decisions based on what their friends tell them.
Now, why do you think that an accredited investor would not do the same thing? I mean, they are older, and probably maybe it's a lack of knowledge of technology, or the lack of social media presence that they may have. Why don't they have that same loyalty? I mean, you would think if they want that kind of return on their investment, they would be blasting it out as well, and that makes the unaccredited investor a boon, like our topic is, to this space. Why would an accredited investor not do the same thing? Our audience is accredited investors, and if this is an encouragement to them to say, you have a stake in this, why would they, as a generalization, not do that?
As a general rule, they're not as active in social media, whereas the unaccredited investors are more likely to be, I guess, using the social media networks literally on a daily basis for their routine communication between themselves and their friends. That is, I would say, not the norm for typical accredited investors who usually are over age 50. So that, I think, is largely the reason that we won't see that. Secondly, it goes back to the other reason we mentioned, that the younger folks, the millennials, are more likely to see it as part of their duty, as part of the community, to help create a success with this company that they believe in. Whereas a typical accredited investor, more in the baby boomer generation, is more likely to believe, hey, I'm an investor, the promotion of the company is not my job, that's the company's job. And they will kind of create a line between those two areas of responsibility, and not likely to take it onto themselves in the same way that a millennial might.
So maybe a lesson to be learned there then, from the example of the younger generation, to say this really does make an actual impact, a discernible impact.
Absolutely.
This behavior.
Absolutely.
So switching gears just a little bit, I read somewhere that you are working to start an equity crowdfunding platform company. Can you talk about what that is? And I want to ask also, is it too early to get started on that, considering that the SEC hasn't necessarily green-lighted it? And can you because of that experience you're walking through right now, can you make some predictions about the equity crowdfunding space in the future or going forward from this point?
Sure. So that is correct, Alicia. We are currently building an equity crowdfunding portal. And what that means is essentially it's somewhat akin to an electronic bulletin board, which will allow companies known as issuers to list their investment opportunities on our platform and allow the public to see and invest by committing right over the portal to making investments into their companies. So much like Kickstarter or Indiegogo, it's really just a bulletin board, an opportunity and place where issuers will list their investment opportunities and their various required disclosures, including showing their business plan, the use of proceeds, a little bit about their background and financial history, and they will then put those up on the portal itself. In terms of how that will roll out, we are not currently operating live today. We have our portal is built, but we're keeping it under advice of counsel in a closed beta mode where we have companies listed, but they're not exposed to the public. The reason why is that we're awaiting the SEC's finalization of the rules for Title III. And we expect to see that. We understand that it's on what's called the SEC's unified agenda, which is kind of a goal-setting placeholder for the month of October. And we're very hopeful that during the month of October, the SEC will vote on the final rules. And once they do so, it'll get published in the Federal Register, and it'll take about 60 to 90 days to get the final rules out.
So it has a potential of moving forward a little faster than sort of people have been sitting and waiting. And at this point, there is some progress being made.
Oh, there's definitely progress. We have a law that's on the books as a component of Title III of the Jobs Act. That law was passed in 2012. We have proposed rules that were very extensive, detailed, and were developed by the staff of the SEC that were put out for comment last November, and then the comment period technically closed in February. So we've got an open and closed comment period, and then finally we've got a SEC commissioner, the chair of the SEC, in fact, has gone on record twice this year saying that Title III, which is the unaccredited investor crowdfunding rule, is a high priority to the Commission, and that she intends to promulgate the final rules this year.
And what happens to the unaccredited investor at that point? How does their life change?
Well, that's when they will be finally given the opportunity to do more than just rewards or donation-based crowdfunding. Instead, they'll be allowed to do investment crowdfunding in the same way that the accredited investors are able to do today.
Okay, so now I want to talk for a moment about what you're doing right now. We mentioned at the top of our discussion that you are with StartEngine out in LA right now. Can you discuss just for a minute about what you are doing? What is StartEngine, and what's going on with you in that space right now?
Sure. So we started StartEngine as a technology accelerator. And what that means is that we invest in tech and media startups. And over the past 2.5 years, we've invested in 57 startups, several of which are incredibly successful and have gone on to raise more than $1 million in angel and venture capital financing. In addition to that, we recognized that in using our judgment to select teams and concepts, that we could probably do a whole lot better by letting the crowd validate those teams and concepts instead of our judgment. And we think about there are so many companies that initially were not very well received in the investment community. Twitter, in fact, being one of them. It took the founders of Twitter a long time to finally get some investment capital because most people thought the idea itself was kind of silly. And same with Snapchat was like that as well. But yet these companies have gone on to create tremendous economic value and become extremely valuable companies. And so those are the kinds of companies that we'd like to give the opportunity to, so that, in fact, we bring forward new technologies that make the world a better place and that also create tremendous economic value for investors by giving an opportunity to these founders to launch great companies.
And you mentioned a little earlier that accredited investors tend to shy away from tech and those sort of up and coming, maybe high volatility but high potential for success type of startups. And you've done a lot with startups. And why should that matter to an accredited investor? Can you talk to our audience for a minute about the difference between investing in a startup versus investing in a company in a more advanced stage, and what the value is in that?
Certainly. I think, in fact, probably one of the most dramatic comparisons is just even within the crowdfunding space, when you look at real estate investments, which are currently available to accredited investors through Title II platforms and portals. There's some really great deals out there that have been offered and that so far have been generating returns of anywhere between 12 to 20% annually on the return on the capital. So even though it's early days, I mean, those are some pretty good returns when you compare it to an average of 8% return, let's say, in a diversified equities and debt portfolio in the stock market. Seeing something that, is in the 12 to 18% range in a real estate investment is pretty attractive. Now, no one ever suggests that someone should take their entire net worth or a huge percent of their net worth and invest it, but it's simply just a way of, again, diversifying their investment portfolio. When you contrast that to a tech company, so if we go back to our Oculus example, if somebody had invested $1,000, I believe the numbers are something like a 20 to 30 times return. Is it a 200 times? Maybe it's a 200 times return. So somebody put in $1,000 into Oculus. When it sold to Facebook for $2 billion, they would have gotten $200,000 back. It's those kinds of returns that are coming in the tech and media space that are dramatically different from real estate. But again, just as we were talking about for crowdfunding investments in real estate, same with crowdfunding investments in tech and media. It is not something that should be a huge percentage of someone's investment portfolio, but rather simply gives an opportunity for someone to invest, to connect, and to make a very substantial return by investing in tech startups that will create 20 and 30 times returns within a few years.
Well, because of your experience with startups, I know you've probably seen every scenario that probably could crop up. And if accredited investors are less likely to invest in a startup, but do, what do you see them misunderstanding that maybe they should know that would maybe make the process easier or more successful for them? What advice could you give them about getting into the startup game?
So clearly, just as you do in any other type of investment, having a portfolio of diverse investments is critical. In other words, putting a large number of dollars into a single company is not advised, and rather investing across a number of companies and essentially building a smart portfolio of crowdfunded investments is definitely preferable, given the risk inherent in any startup, whether it's in any form, regardless of how that capital is raised. The second thing to consider is, to look at the value of the company, both currently, valuation, and what it likely could grow to. And the third thing is finally look closely at the team. When we look at companies, about 75 to 80% of our decision is based on the quality of the team over the quality of the concept. And the reason why is that in the startup scenario, it's often likely that a company will have to pivot and change their business model at least once, if not several times, before they hit market success. And what that comes down to is a team that can actually recognize when a pivot is necessary and then execute that pivot well and meaningfully in a financially prudent way to ensure that the company ultimately becomes successful.
And my next question actually was something along those lines. The can and can't. What can they do? What should they not do? Accredited investors, that is. When unaccredited investors are going to step into the ring, is there something accredited investors can do to help smooth the path rather than get in the way? And we're talking about it being a boon to them, and who would want to get in front of a boon, but you may accidentally or inadvertently do that. What can we do to make it a smoother process for everyone?
So under the unaccredited investor crowdfunding rules, there is an annual cap. A company may not raise more than $1 million total. And so that cap is enough to validate a concept and begin proving the market value proposition. What accredited investors can do is to either team with or form a part of the future rounds of financing that are going to be necessary to carry that business from its startup phase into an early growth phase. And I think in collaborating together, whether that be through things like AngelList or becoming part of a syndicate on a Title II portal, providing that downline financing for these startups is absolutely critical, and I think can probably enhance the likelihood of success. And of course, the accredited investors get to see that deal flow that's already been validated. In other words, they've already seen that team and that concept perform, and they already have a good sense of which ones are likely to make it.
Okay, so my next question, and to wrap things up, will you talk for a minute about the startups themselves? And we started the discussion talking about how unaccredited investors will be a boon to accredited investors, and one of the concerns is, and we talked about the wisdom of the crowd, but from a startup perspective or an entrepreneurial perspective, working with a large amount of essentially inexperienced investors, will you just discuss that for a minute? What is that going to look like, and will it be problematic, or is it going to be smoother than people probably think?
That's yet to be seen. I have a belief that there is certainly going to be some challenges, as there always are when anytime there's a multitude of shareholders. It could be as small as 3, and it could be as big as 300 or 3,000. In any case, when there's multiple shareholders, people come to different conclusions, or they think about things differently, and because of that, there's likely to be some conflict. So I don't want to for a moment say that this is going to result in smooth as sailing. Absolutely not. I do think that there are going to be structures which are going to evolve, and that the market is going to validate, meaning that once these structures are put in place and used and tested, that there will become a preferred way that companies typically structure their cap tables. And when they do that, it'll be done in a way that furthers the possibility and probability of downline financing. The cost of having to deal with the number of investors is going to be offset by the value that those investors bring in their engagement of their own social media networks. So if you have 1,000 investors, and on the average, each of those investors bring 100 social media contacts to bear, we now have 100,000 social media contacts that are going to be promoted to by 1,000 investors on an ongoing basis. The power that brings will offset the cost and challenges of having to manage a cap table with that many investors.
Thank you for that. And I want to just conclude by telling you that I really appreciated you taking the time to talk with Accredited Investor Markets Radio today. I think it was really informative and hopefully dispelled some of the fears about working in tandem with the unaccredited investor, that it really can be something very positive. So thank you for that.
Oh, you're sure welcome, Alicia, and thank you for the opportunity. And if there's anything else I can provide, please do so.
Our listeners can find more information about Ron by going to StartEngine.com. You've been listening to Accredited Investor Markets Radio, a weekly podcast devoted to educating investors about the basics of investing in alternative assets. We hope you tune in next time. I'm your host, Alicia Purdy, and we'll talk soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.